Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are about just 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Gina Martin-Adams, counting you down to the closing bell, counting you down to the earnings, here to take us beyond that bell and to Netflix for the global simulcast. It is Tim Stenovec, Katie Greifeld in for Carol Massa, and bringing together our TV, radio and YouTube audiences as we do each day to dissect what has been a pretty risk-on kind of a day, Tim.
Yeah, I mean, all 11 industry groups are higher today. I think it's fair to call this one broad-based, Caroline. And the fact is, Katie, we're actually seeing above-average volumes compared with the last 20 days. So what gives?
Volumes up, stocks up, volatility down. You look at the VIX right now, below 25, just grinding lower and lower, really as stocks rebound.
Well, let's just enjoy the rebound. But let's not question it. You know, Taylor already threw a little cold water on it by telling me that the last time we had a big rebound like this was just in June. But nonetheless, it does look pretty broad-based. It does look to be led by cyclical sectors with defensive sort of lagging, but basically every stock up. And that's usually a pretty solid sign of some risk tolerance reemerging.
I think what's interesting, then, we'll give a big shout out to Gina. The last time we had her on the last quarterly earnings season, the market fell apart, and I looked at her and I said, what happened? She said, tech quarterly earnings is what happened. This, Caroline, sets us up to sort of the beginning of Netflix today, further out this week as well as some of the others, about how we're thinking about sentiment in this market.
The Teslas, the Twitters, we've already had the banks, and of course, actually, notably did relatively well. And we really get a mixed bag when you look at what happened with IBM. It beat, but the dollar worries really hit free cash flow, and that sent the shares lower. J&J too. I won't steal people's thunder because I know they'll be talking about these stocks, but overall, 12 seconds to go, the cheers are occurring over on the NYSE and the Nasdaq, and the S&P 500 is up more than 100 points. We don't see that too often at the moment. We're currently up 2.7% on the S&P 500 as we start to settle out this day. The Nasdaq is up 353 points, more than 3%. No wonder they're cheering so hard. We're also looking at the Dow Jones, seeing a day of 750 point higher, solid day, 2.4%. We are already, it looks like, starting to get a drip feed of Netflix earnings, and it sees a third quarter streaming paid net change of up 1 million. That is a big miss for its forecast. In terms of its third quarter streaming paid net change, they see just 1 million increase. The market wanted to see 1.8 million. For their second quarter, streaming actually came in, well, better than expected. It didn't fall as much as had been worrying about. We saw 970,000 losses in terms of people actually paying for their Netflix subscription. The market had thought it would fall off by 2 million. This is a very mixed bag. No wonder the market now, after hours, seeing a 9% pop, because they are breathing a sigh of relief on what the second quarter brought us. But what about that forecast overall? And what about, they say they're going to be seeing a foreign exchange impact that was worse than expected. That's all about the dollar. Re-accelerating revenue growth is a big challenge, they say. Interestingly, they're doing a deal acquiring an animation studio, Animal Logic. There are no terms there. They're going to be funding the deal with existing cash balances. But overall, they saw a $339 million foreign currency impact. Again, this is talking also about Stranger Things. The Content 4 had 1.3 billion hours viewed the first 4 weeks. That's on you, team. That is on people out there spending 1.3 billion of their time on Stranger Things for Taylor.
And you hear this from the CEO saying that both of our challenge and our opportunity, we have to re-accelerate revenue and membership growth. We have to improve our product, our content, and our marketing. And we have to monetize our big audience. And Gina, not only getting to some of the FX headwinds that they also cite in parentheses what it would have been on a constant currency basis. And we're seeing signals of that through all of the quarterly earnings. But again, sort of thinking about the challenges and the opportunities, how do you think about sort of the monetization of what this company has to do?
Yeah, and I do think it is about the outlook. So pretty big beat, really, on second quarter, but they had guided so low that the market was already anticipating something of a beat. How will they overcome the subscriber losses ultimately in an environment where the competition, as we just talked about, the competition is so very fierce? I think that one of their struggles is going to be over the next couple of quarters really proving to have some sort of sustainable margin as well. And they've kind of guided the investment community to expect better margin going forward. How will they create that with this constant subscriber loss when you're looking at next quarter's subscriber loss still roughly equal to the current quarter's subscriber loss? It's not a good sign of the sustainability of margins going forward.
We can get more on that, all the fundamentals. Geetha Ranganathan, of course, our U.S. media analyst, joining us now here from Bloomberg Intelligence. Geeta, a market right now in post-market trying to weigh better than expected second quarter, but a third quarter that doesn't look great either. How are you weighing these results?
Yeah, there's really not a whole lot to cheer about, Taylor. I mean, yes, it was not as bad as feared for the second quarter. I think a lot of that we can owe that to, the success of Stranger Things. They were pretty good and kind of, spreading that out also over 2 quarters. So, maybe churn would be a little bit controlled because of that. But then again, you look at the third quarter guide, that's not reflecting a whole lot of optimism. So, we were looking for about 2 million. We're only at about 1 million. And there's really, I think, what the market is really looking for at this point of time is really some clarity, not just on the subscriber growth trajectory, but also on other metrics. So, how are they going to drive ARPU? How are they going to drive margins? I mean, Gina just spoke about that. And you look at the margin guidance for the third quarter, it's 16%. So well below the 19 to 20% that they were that they're guiding to for the full year. And so there's pressure all around, top line, bottom line, subscribers, everywhere.
The company, Geeta, has made a lot of changes in the most recent quarter. They cut costs, they laid people off. The company now planning to introduce this lower priced ad-supported version of the service. How does the company do this in a way that doesn't cannibalize people who are paying for that ad-free tier? And then essentially what they're doing is they're trading down for a less expensive version, but might not be as profitable for the company.
Yeah, so this has kind of been a real, head scratcher, and it's this is why people are unable to get too excited about this right now until and unless we have all of the details. So remember, advertising is not in Netflix's DNA. This is something they have to build from scratch. And yes, you're absolutely right, Tim. They are going to be trading down, and yes, cannibalization is a huge, huge concern. But at the same time, they do have a lot of positives working in their favor. They are the largest streaming platform in the world. They do have 220 million subscribers across the globe, and they do have an average household spending over 2 hours per day on their platform. And that is what advertisers are looking for. They're looking for eyeballs, and they're looking for that constant engagement. And so the thinking is that they should be able to charge ad prices that are pretty robust. So if a Roku, if a Hulu right now is charging, let's say $30, $40 CPMs, Netflix should be eventually able to charge maybe even 50% above that, just kind of given the quality of the audience and what they can offer advertisers. And so the general thinking is that their overall ARPU, even though the price is going to be lower, just the amount that they can get with advertisers would actually lead them to have, a total ARPU which is higher than a standard plan. So in the US, it costs about $15.50. Maybe with the advertising element introduced, they can get about $17. So they're not really going to be sacrificing unit economics.
And Geeta, when it comes to what drives eyeballs, theoretically, it's the content. I'm sure we would all like to believe that. And in terms of the content pipeline at Netflix, I mean, is it robust enough to necessarily reverse what we're seeing in terms of subscriptions?
It is pretty robust. So, we have the Gray Man that's coming out. It's supposed to be their biggest film ever, the costliest film ever, I should say. They do have new series coming out as well. You have Sandman, you have The Crown coming in later. There are a lot of different films. So yes, they do have a content pipeline that seems reasonably good, but reasonably good is not good enough anymore because you have all the competitors who are also coming out with their huge content releases, whether it's a Disney that's ramping up big time, whether it's an Amazon that's doubling down on sports with Thursday Night Football and with this new Lord of the Rings series, which is arguably the most expensive series ever created in television and streaming history, or whether it's, a Game of Thrones prequel. So everybody is going after that sub. And in this environment where it's, there's so many challenges with inflation, with recession, you really have to take some, you have to have those big hits and you have to have a steady stream of big hits. And that's really what the market is going to be looking for, any clarity around their content strategy.
Really appreciate your time and instant analysis, as always. Geeta Ranganathan, U.S. media analyst here for Bloomberg Intelligence. Carol, as we digest a lot here, Katie, I should say, my apologies. Katie's, we digest a lot of just sort of all of these numbers here and really think about what this means, not only on some of the free cash flow, some of the currency issues, but again, content, eyeballs, content does continue to remain king.
Absolutely. I would hope so. And I will just say I've been called a lot worse than Carol. And if you sort of weigh what we learned today, what we saw from the company, if you look at what's happening after hours in the shares, Netflix shares up over 6%. So it was kind of a mixed bag, but net, at least the knee-jerk reaction is pretty positive.
Yeah, you have to wonder if investors are right now asking themselves, is the worst behind it for Netflix? After all, the company is going to return to growth, at least in this quarter, saying that it's going to add 1 million members. But, you know, a very expensive quarter for the company with those severance charges and the revamp that they're trying to do internally. Well, that is going to do it for our cross-platform coverage on radio, TV, and on YouTube. We are going to be back here tomorrow at the same time, same place.